go.
All right. Good morning and welcome to the Home Financing Seminar with the Mayo Employees Federal Credit Union. My name is Cheryl Peterman. I've worked here at Mayo Credit Union for over 20 years. I've been in the mortgage industry for over 30 years. If you have any questions, please feel free to type your questions online where I'm happy to help answer. And we'll get started. Thank you all for joining. You're probably asking yourselves, why should I buy a home? Home ownership puts your money towards building equity, quit making your landlord rich, and start getting ahead financially yourself. And you probably are closer to your dream than you would think you are. Some advantage and disadvantage of home buying. Buying advantages, you can build equity. So every time you make a payment, you're building equity in your home. The more you put down, the more equity you have. You're free to decorate, landscape, repair, do whatever you want, make it your own. And you have a sense of an achievement and pride of ownership in owning a home. Disadvantages is your maintenance. You have to obviously pay for that yourself. You do pay property taxes, and property taxes always tend to go up, unfortunately. And sometimes we might have a possible decline in value. That probably happened 10 or so years ago, but right now the market's been holding pretty strong. Some renting advantages is it's easier to move and very little maintenance responsibilities. And the disadvantages of renting is you're losing equity. You're not building any equity in your home. Your rent increases, and sometimes it's maintenance headaches trying to get a hold of your landlord to fix things. The mortgage programs that we offer here at the credit union, we offer fixed rate mortgages of 10, 15, 20, and 30-year fixed rates. We also have ARM loans, a 5 and a 7-year ARM, and we'll cover that in the upcoming slides. We also offer an FHA loan, which is a Federal Housing Administration mortgage. And we also offer VA mortgages, mortgage loans that are guaranteed by the United States Department of Veterans Affairs. We also have a Home Possible program, which is a lower down payment than the conventional financing. Conventional loans are our most common types of mortgages. Generally, these loans are sold to the secondary market, Freddie Mac or Fannie Mae, or other investors. Conforming, we can go up to $726,200, and then jumbo loans start at $726,201. Types of conventional mortgages, fixed rate loans, adjustable rate mortgages, and the Home Possible program. Fixed rate mortgage programs, the maximum loan to value is 97% to 95%. Most commonly, it would be a 5% down payment. So your down payment 3 to 5%. Minimum credit score is in the upper range of 600. And if you have less than a 20% down payment, private mortgage insurance is required on the loan. Adjustable rate mortgages, mortgage programs for a 5-1 or a 7-1, the initial term is set at either 5 or 7 years. The payment is done over a 30-year amortization, and interest rate remains the same for the initial term. So For the 5-year, for example, I believe that interest rate is 5 or 5.625. So that rate would stay the same for the first 5 years. After that, it can start adjusting every 6 months with a 2% cap per year and a 6% cap over the life of the loan. FHA loans, the minimum down is 3.5% down. Credit scores typically can go down to 620. We can do gift funds. Private mortgage insurance is required on the life of the loan, so that never comes off. Like whereas a fixed rate conventional mortgage, that private mortgage insurance would drop off when the loan to value hits 78%. Or if you feel you've reached the 20%, you can always pay for a new appraisal to get that PMI removed. There is an upfront funding fee of 1.75 on the loan amount, and there's a monthly fee for the life of the loan. Maximum loan amount is set by the county where your property is located. So different counties, different amounts. Home Possible, the LP Home Possible program is for borrowers looking for a lower down payment, including first-time home buyers. Single-family homes, typically, it's a 30-year fixed-rate loan. Maximum loan-to-value is 97%, and there's really no minimum credit score. However, the loan must score accept, and that's something that we do here in our office to see if it does score accept. And the eligibility, you cannot, borrower eligibility cannot as of the note date have any ownership in another residential property, so you can't own another property and get this type of mortgage. Down payment, gift funds from a blood relative are allowed. So blood relative, we're talking mom, dad, aunt, uncle, brother, sister, something like that. There isn't any reserve requirements, so you don't have to have so much in your savings or your checking account. Private mortgage insurance is required, and there are income limitations on this program, and they cannot exceed 100% of the area median income. So the different counties, for Olmsted County is $62,450. For Duval County in Florida and St. Johns County in Florida is $46,850, and then for Maricopa County is $49,500. And there are some homeowner education that you have to complete. Yeah, go ahead.
Are those median income, is that per person or per family?
It would be per family. The median income is per family, not per individual. Pre-qualification is good, but a pre-approval is better. Pre-qualification gives you an estimate of what you can afford, and that's something that we would talk to you over the phone about. If you're thinking about buying a home, you can just call us, and we'll kind of ask, what your income is, what your debt load is, including credit cards, car loans, student loans, things like that. And then we can give you an estimated amount of how much you could possibly be pre-qualified for. A pre-approval would let the seller know that you have ability to secure a mortgage, and really a pre-approval is the best way to go if you're looking for a house within the next 90 days. The pre-approval letter is good for 90 days, and we would have you fill out the application out on our website, and then once we get that here in the office, we'll do a hard pull on your credit, and Sometimes we'll ask for pay stubs and W-2s, sometimes we don't until you actually find a house. That's when we'll start collecting that documentation. And a pre-approval letter does really strengthen your buying power because it does show your realtor and the seller that you have taken an initiative to look through everything and make sure that you're good to go. And our pre-approval letters are good for 90 days. And after that, we'd have to pull new credit and kind of pre-approve you. So the application process, after selecting your lender, you may be asked to supply the following documentation. Copies of a recent pay stub within 30 days of your application. We usually get a couple of current pay stubs, and then we usually get a couple of your last W-2s. And if you're self-employed, we would ask for a year-to-date profit and loss, and then 2 years of your most recent tax returns. For the bank statements, we'll ask you for 2 months worth of bank statements. If it does show any large deposits, we'll need proof and documentation of where those deposits are coming from. And if you're divorced, we would need a copy of the full divorce decree. If you've had a bankruptcy, we would need bankruptcy papers and discharge notice. And then a copy of your homeowner's insurance information. So if you're purchasing a home for the first time, you'll definitely want to shop around for your insurance agent, and then we would need a copy of that binder a couple of weeks prior to closing so we can get everything ready to go for your closing. Mortgage qualification, income and assets. Sometimes there are reserve requirements. So basically for a reserve requirement, we can get a copy of your retirement statement to just show that you have funds in reserve. Job stability is a huge thing. You know, if you're a job hopper, it might take you a little longer to get pre-approved to buy a home. You know, the people that have had good stability, that have been with their job over 2 years or more, that's definitely helpful. Your debt to income ratio, expenses not to exceed more than 40% of your gross monthly income. And really, I mean, I'm going to tell you that you probably qualify for more than what you think you do, but you definitely want to be more comfortable making your payments. For example, you know, if you're paying $1,200 a month in rent and your payment on your new home is going up to $2,000, are you really comfortable with paying that amount? You know, I can tell you that you're qualified for it, but it's whatever your comfort is and how you feel about it, because you're the one that's going to be making the payment. Yeah, question.
In your opinion, what is the best debt to income ratio? Like, what is, like, the slide says 40%, but what is realistic in your opinion? For most people that you work with.
Most realistic debt to income ratio, I would say probably anything in the 30s price or any debt ratio. Anything in the 30s would probably be good. You know, if it's less, that's even better for you. But like I said, we're going to tell you qualify for a lot more. So, you know, it's whatever you feel you can afford. And then your credit score does play a huge factor. It would determine your interest rate. Minimum score of 780 for the best rate, and then scores below 650 may not qualify. not only your credit score does it determine the interest rate, it would also, if you have less than a 20% down payment, it also determines your private mortgage insurance as well. Go ahead.
Can you talk more about private mortgage insurance, what that means?
Absolutely.
You just mentioned something about 20%.
Yeah. Private mortgage insurance is an insurance that we carry on our loans if you have less than a 20% down payment. It is required on all loans. And basically, it's an insurance. If you default on your payments, we get paid. So that's what the insurance is for. And you have to carry it until you have 20% equity. At that time, you can pay for a new appraisal to see if you can drop your private mortgage insurance, or it automatically falls off when your loan to value hits 78%. It will automatically fall off. Sure.
So is that just a credit union thing, or is that like industry standard?
Industry standard. I think everybody requires the private mortgage insurance for a down payment of less than 20%. Source of down payment funds. Borrowers' funds can come from any of the following. Deposit. A 30-day history is required. A secured loan. So what I mean by a secured loan would be like a car loan, because your money is secured by your auto. So we could do that. We could do like a boat loan because it's a titled thing. We can't do a credit card advance. That's not allowable. Sale of assets, like your current home, if you're selling your current home to qualify for the new one. Your earnest money, and what earnest money is something that you hand to your realtor that they're going to give to the seller, basically to hold the property. So that earnest money, let's say it's $1,000, will go towards your down payment. Gift funds from a blood relative. Retirement accounts, and that's the 401k employer must approve. That's something you would definitely want to check with your employer to see if they allow that, because there are people that do not allow that. Funds needed at closing for the down payment. Let's say the purchase price is $175,000. 5% of that is $8,750. So your loan amount would be $166,250, and your rate is 6.375 on a 30-year fixed. So your monthly payment is $1,037.19. And then the reserve requirement is your principal and interest, your taxes, your insurance, and your PMI. So in this case, it would total about $250.38. So your total, your PITI, which is principal, interest, taxes, and insurance, is $1,287.57. And then 2 months of reserves of the PITI would be $2,160.62, and those funds must be liquid. So what we mean by liquid is having them in a savings or a checking account. And the closing costs, some of the closing costs, or all of the closing costs, like 3%, could be paid by the seller if they're willing to do that for you. But typically, closing costs run around 3% of the purchase price. And now participants in the home buying process. So your lender, that would hopefully be us. You're the buyer, the seller, the person selling the home, the real estate agents, and that's something, really talk to people about different realtors and maybe go to a few different open houses and meet realtors and you'll know within 2 minutes if you click with a realtor or if you don't. And if you don't, move on, because here in Rochester, there's about 999 other realtors that would love to work with you. So you want someone on your team that's really going to be on your side. So definitely, ask around, or you can ask us. But your agents, your home inspector, and a home inspection is something that you'll want to talk to your realtor about to see if that's something that you choose to do. An appraiser is someone that we will hire. We will collect $500 up front to cover the appraisal, and then we'll order the appraisal after the home inspection has been done, because we don't want to start spending your money until you know for sure that you're going to go through with buying the home. And then a escrow, closing officer, or title company, or attorney's office, any of those three, and then the loan servicing company. That's the people that you would make your payments to. So the home buying process is you meet with your lender and you're going to determine your maximum loan amount. Like I said, what I am going to tell you is probably different than what you think you can qualify for. We'll go through the different loan options. Some people prefer an ARM because they know they're not going to be there for more than 5 to 7 years, so that actually works out better because ARM rates are a little lower than the conventional loans. And then your down payment and your closing costs, where that's going to come from. And the hiring of your realtor, definitely check different ones out. Like I said, you're going to know within the first couple minutes if you click with them or not. And then you're going to negotiate an offer. I mean, if you see a sales price, we'll say of $300,000, and you're thinking, oh man, that just seems a little too high. Maybe I'll offer $295,000. Talk with your realtor. They're very knowledgeable about that, and definitely be cautious of the lowball offers, because sometimes that turns the seller right off, and they'll just move past your offer. So your interest rate lock, we can lock in your interest rate once you have a signed purchase agreement signed by you and the seller, and we're within a 90-day time frame of your closing. That's when we can lock into your interest rate. And when we lock in your interest rate, that's what you're going to be locked at. We can't relock you if rates go down or if rates go up. We can't say, hey, rates went up, we're going to charge you a higher rate. We can't do that. So just so you know, that's a huge part of your process. And then after we get you locked in, after you do your home inspection, then we're going to order an appraisal. We'll collect the $500 up front, and it usually takes 10 to 14 days to get that appraisal done. And then once that comes in, then you will get a copy. That's your completed appraisal, and you'll receive an email with a link to the report. Your loan file is then sent to the underwriters for review, and it usually takes them 3 to 5 days to review it. So once the appraisal comes in, we're going to send your whole file, your pay stubs, your W-2s, your bank statement, your application, all of that good stuff is going to be sent into underwriting for final loan approval. And then final loan approval is your clear to close. And sometimes when your file comes out of underwriting, The underwriter is going to want more documentation, and this happens more often than not. So your processor will call you and say, hey, you know, the underwriter wants to see you have a $10,000 deposit into your account. We're going to need to see where those funds came from. So don't be shocked if your processor calls you and says, hey, we need more documentation. It's pretty normal. So once we have the clear to close, our closing department will work with the title company to create the closing documents that you'll sign at closing. And in 10 to 14 days, you will receive your final figures. Usually that's about 3 days prior to closing. You'll receive your final figures so that you know how much you have to bring to closing, because you either have to bring certified funds or you have to send a wire. But our processors will help you out with that. Yep, 3 days prior to closing, your final figures. And then for the closing, you're going to sign the documents with the title company or attorney's office. 2 to 3 weeks later, you're going to receive a welcome packet in the mail from us with your loan number and online access instructions, so you can access everything online. So what determines your credit score? I think this is interesting. So your 30% is the amounts that you owe. So if you tend to use your credit cards a lot, pay them off if you can every month. Don't leave balances sitting out there. Just use your credit card to charge gas, charge groceries, and pay them off if you can. 10% is new credit. I would be really leery of opening any new credit when you're within the process of purchasing a home. 15% is the length of the credit history. So if you have credit cards and things out there that have been out there for a while, don't close them, just leave them. And then 10% is a credit mix, and that's unsecured and secured. So car loans, boat loans, motorcycle, anything that's titled, house, that would be secured. And unsecured is credit card debt and things like that, line of credit. And then your payment history, that's the biggest part of just make your payments on time. That's really going to help increase your credit score. And here's some credit report information. You can go to the annualcreditreport.com to get your free annual report. And I would suggest doing that so you know what you have out there, and make sure that nobody else is using your credit. That's huge. You can also freeze your credit too, just to protect it. But if you're going to do that before purchasing a home, we'll have to have you remove the freeze so we can pull a tri-merge credit report. And you'll ask, why do business with the credit union here? We offer personalized service. We're here all the time. There's 3 of us that do mortgage loans. We do have reasonable closing costs. We have a discounted origination fee, which is 3/4 point, and other standard industry is 1%. We don't have any prepayment penalties on any of our loans. You can set up automatic monthly payments. We do offer web access to our mortgage information. And our servicing is retained. So what that means is our servicer will keep your loan. They won't sell it, and you'll have to follow your payments all over. We don't work on any commission. We're here for our members. And over the last 2 years, Mayo Credit Union has assisted over 1,000 members with mortgage loans for a total of $300 million in home financing across the United States. And we can lend in a lot of the states. I don't think we can do Alaska or Hawaii at this point, but we have members all over that we finance homes for. And this is our mortgage team, Donnie Pierce, me, and Dennis, and we've all been here for a good amount of time, very knowledgeable. Can I answer any questions?
What is the point of an appraiser? So after you get your home inspected, or if you do, like what's the point of an appraiser? Good
question. So the point of an appraiser is he's going to, I know the home inspector goes out and gets up in the attic and gets up on the roof and does all of that, but an appraiser is basically going to compare the home that you're purchasing to 3 other homes to make sure that the value is there. So they're really looking at the value of the property to make sure that it's worth what you're purchasing it for.
What if it's not? Like, what if you're way over everything?
So if the sales price, if the appraised value comes in under what you're purchasing, what you'll do is you'll go back to your realtor, and then they'll go back to the seller's realtor, and you'll negotiate. You know, hopefully they'll come down. I've had some instances where they don't come down, and then it would be your responsibility to make up the difference. And then if it comes in over value, bonus, you just gained more equity in your home. That's not going to change your loan to value, of course, but that's good for you that you got a good deal on it. Yeah.
Comment here from Paul online. Could you comment on a bridge loan?
Sure. Basically what a bridge loan is you haven't sold your current home yet, you're purchasing a new home, and you want to use the equity from your current home to put in your new home because you haven't sold this one yet. So basically what a bridge loan is, it's basically a home equity loan that will take out on your current home, take that equity out of there to put it on your new home. So it's basically a home equity loan. Sure.
Another comment here from Tina. Circling back to down payments, what is the down payment percentage required to buy a property, and how does this impact PMI? Thanks very much.
Sure. Typically, the down payment is 5%. Anything less than a 20% down payment does require the private mortgage insurance. So if you can swing a down payment, that's better for you. You don't have to pay the private mortgage insurance. Most of us cannot do that, so you pay the private mortgage insurance.
Can you talk a little bit about the benefits of approval and how long loans rate?
Sure. Getting a pre-approval, the benefits of getting a pre-approval is basically to show your realtor and to show your seller that you have taken interest in checking your credit and doing the loan application and having a lender look at everything for you. And then what we'll do is we'll give you a pre-approval letter. It'll state that you've been pre-approved for whatever amount. And then that pre-approval letter is good for 90 days. Sure.
2 questions. This one's a quick one. Going back to bridge loans. How long is a bridge loan good for?
A bridge loan, good question. We'll take it out. It's a 15-year term for on a home equity loan. So depending upon how long it takes you to sell your home, once you sell your home, you'll pay off your bridge loan.
And then another one from Evan here. Is a standard savings account the best place to keep my savings as I prepare to buy a home?
Absolutely, yep. Any, savings checking, anything that doesn't, I kind of steer clear of like a certificate, a CD, just because if you're taking money out of there, chances are you're going to have to pay a penalty to remove your money out of that. So anywhere that's easy enough for you to get your money for a down payment is a good place to put it. We can't use mattress money. So this has been years ago, but somebody had won a bunch of money at bingo, and they were going to use that for a down payment. We couldn't use it because we didn't have the documentation. So sources like that are going to have to sit in your bank account for 30 to 60 days before we can use that. Go ahead.
What's the purpose of 30 to 60 days?
It's called seasoning. So it seasons in your account, so it sits there, so then you don't have to provide documentation of where those funds came from. And I'm sorry, Christian, you asked how long it takes to get a pre-approval letter. I'm sorry, I didn't. So, yeah, pre-approval and closing. So a pre-approval letter, if you applied tonight, for example, if you filled out an application out on our website, we could probably get that pre-approval letter out to you either Thursday or Friday for sure. And for a closing right now, it's about a good 30 days to close a loan. So if this is something that you're looking at now, you sign the purchase agreement today on, is it May 17th? You'll probably need until June 17th to close your loan.
Anything else you want to talk about real quick, or things you've seen recently?
I had an interesting thing happen last night. So my neighbor, she's actually selling her home, and I've kind of been just helping her a little bit. So last night she got 5 offers on her home. So we sat down, and we meaning her, myself, her son, and the realtor, and we reviewed the offers. I've never done that before, so it was kind of cool. But right now, the market is crazy. I mean, her sales price, I believe, was $199,900, and she got offers from $199,900 up to $220,000. And there was a VA loan, there was a couple FHAs, and a couple of conventional loans. So I just thought it was interesting going over those offers and, choosing, how do you choose? So we kind of, all of us discussed it, and we picked out the best offer. But it's, and some people wrote letters, that's common, how they're a family, and we're really going to enjoy your property as a family, and things things like that. So I just thought it was really interesting. Go ahead.
I'm just kind of commenting on that because as a seller, your neighbor's a seller. Are certain loan types more, despite the offer amount, are certain loan types more appealing to sellers, or is it just pure dollar amount?
So she did get an offer for $220,000. She declined that offer, and she did take an offer for $210,000 because it was a conventional loan, and the buyer had a 20% down payment. So, and I'm not saying that an FHA, VA, or people that have a 5% down payment wouldn't, she wouldn't, but that just seemed like the best offer. Now, all of the offers had an inspection contingency, so she still has to go through, that house has to go through an inspection to make sure that, you know, things are okay. And in one of the clauses, in one of the purchase agreements, it just stated right on there that if the inspection showed any repairs needing done, they would not ask her to do any repairs, which I thought, wow, that's huge. So it just kind of all depends, and that's something that you're gonna really work with your realtor on, you know, of what you want to put in the purchase agreements. Some of them asked for seller paid closing costs, which, you know, that's fine. So it just was a lot of different things, and I've never seen that before. I thought it was very interesting. Any other questions?
We haven't had you come in, but if you just want to mention the next presentation.
Oh, sure. Cameron's going to be doing a car buying seminar at about 12 or 12:15? 12:15, so if you have time, hang out. We also have some good certificate CD specials, so go out and check out our website. If you have any questions, feel free to give me a call, give my colleagues a call. We're all happy to help. We want the home buying process to go very smoothly for you, and we welcome any questions. Can I answer any other questions? Thank you all for attending. I appreciate it.